Okay, so you're back for more deep dives. Well, today we are going to try to do something kind of cool.
Okay.
We're going to look at a really fascinating article about investment strategies.
Okay.
And we want to try and get through the key points in under 3 minutes.
All right. Speed run.
Yeah, speed run, exactly.
Do it.
And hopefully, we'll be able to give you a really good understanding of what the strategies are.
Right.
And more importantly, like what the real differences between them are, because this piece covers like a whole spectrum.
Yeah.
Right? It goes from, the real like broad approach of index funds all the way up to, like day trading momentum stuff.
Yeah. What I really appreciated about this article is it kind of takes the mystery out of investing. Like, a lot of people think you need some fancy degree from Wharton or something
Right.
to be a successful investor.
Yeah.
But it really emphasizes that anyone can do it. And it's just about understanding like a few key strategies.
Okay.
And most importantly, figuring out which ones really work for you. So like, your own financial situation, your goals, how much risk you're comfortable with. I mean, that's huge, right? And the article even kicks off with like these 4 questions
Okay.
to kind of get you thinking about that alignment.
Okay. Well, let's just dive straight in then.
Yeah, let's do it.
The first one that it talks about is passive index investing.
Right.
So what's the core idea there? Like if you had to sum it up, what's the main thing people need to know about that?
So basically, it's all about trying to match the performance of a market, like a big market.
Okay.
Benchmark like the S&P 500.
Mm-hmm.
And you do this by investing in, mutual funds or ETFs,
Okay.
exchange traded funds.
Right, ETFs.
Right. And those are specifically designed to track a certain index.
So it's almost like buying a little tiny piece of all the companies.
Exactly. You're not betting on one horse, you're betting on the whole field.
Okay, I like that.
Okay.
So then what are the advantages of that?
Yeah.
For like somebody like me or you, what makes it such a good choice?
I mean, first of all, diversification. Okay.
Right, because like with a fund that's tracking the S&P 500, you're invested in all these different companies from like, all sorts of industries.
Mm-hmm.
So you're not putting all your eggs in one basket.
Makes sense.
Right. And so that really helps to reduce the volatility
Okay.
compared to, just picking like one or two individual stocks.
Right. Yeah.
And then also it's like super hands-off.
Okay.
Once you're in, the fund manager is basically just trying to keep the fund matching that index.
Right.
They're not actively like picking winners and losers.
Okay.
So that usually means lower costs,
Right.
lower fees, less trading.
Yeah.
And the article even mentions potential tax benefits because there are fewer taxable events
Interesting.
when there's not as much buying and selling going on.
Huh. I see.
Yeah, and what's really amazing is that passive investing has just exploded in popularity.
Really?
Yeah, it's like now something like half of all the trading volume in mutual funds and ETFs is passive.
So it's clear that a lot of people are finding it appealing.
Okay, well, let's move on to the next one then. Value investing.
Yeah,
And I think you described this earlier as kind of like treasure hunting,
absolutely.
which I thought was a really good image. So what do you mean by that? Like, what are these treasure hunters looking for?
Okay, so they're basically on the hunt for stocks that they think are trading for less than they're really worth.
Okay.
Like below their intrinsic value, what the company is actually worth.
Mm-hmm.
The basic idea is that the market, it doesn't always get it right.
Yeah.
Sometimes stocks get mispriced
Okay.
for whatever reason, and that creates opportunities.
Opportunities to buy low.
Exactly, to buy those bargains.
Yeah.
And then potentially you make a profit when the market kind of corrects itself and recognizes the true value.
So it's not just about finding like a cheap price. It's more about like finding something that's actually worth more than what it's going for.
Exactly. It's like finding that hidden gem,
Okay.
that diamond in the rough, where you've done your research, you understand the fundamentals, and you see that disconnect between what the market is saying and what you believe the real value is.
Right.
So that's the aha moment.
Okay, so how do they find these gems?
Well, they spend a lot of time doing something called fundamental analysis.
Okay.
And that basically means they're digging deep into the company's financials,
Okay.
looking at their earnings, their assets, their debt, all that stuff to try to figure out what the company is really worth.
Okay.
And one of the metrics that they often use that the article highlights is the price earnings ratio.
Okay.
The PE ratio.
What is that exactly?
So basically it tells you how much you're paying for each dollar of earnings that the company is generating.
Okay.
So a lower PE ratio can sometimes indicate that a stock is undervalued, but it's just one piece of the puzzle. You got to look at the whole picture.
Right, of course.
And value investors are generally in it for the long haul.
Okay.
They're patient. They're willing to wait because it can take time for the market to catch up and recognize that true value.
So it's not a get-rich-quick scheme.
No, not at all.
It's more about like steady and slow wins the race kind of thing.
Exactly. And the classic example is Warren Buffett.
Right, yeah.
He's like the poster child for value investing. He's built his whole empire on that approach.
All right, well, that's value investing. What about growth investing?
All right, so growth investing is less about finding a bargain
Okay.
and more about anticipating future success.
Okay, so it's about looking ahead.
Exactly. They're looking for companies that have the potential to really grow their earnings in the future.
So like the up-and-comers, the rising stars.
Exactly. They're looking for the next big thing.
Okay.
Like maybe it's a company that's developing some groundbreaking technology, or they're in an industry that's just taking off. Something like that.
Okay, and what are some of the key characteristics of like a growth stock or growth company?
Well, one thing is that they often reinvest a lot of their earnings back into the business to fuel that growth. So they might not pay out big dividends.
Okay.
And then because their value is so tied to, future expectations,
Right.
their stock prices can be more volatile.
So higher risk, higher reward kind of thing.
Exactly. And the article points out that growth investing doesn't always rely as heavily on that deep fundamental analysis of, the current financials like value investing does. So that might appeal to some people.
People who maybe don't want to get bogged down in all the nitty-gritty details.
Right, exactly. They're more focused on the big picture, the long-term potential.
You still have to be careful. Right.
Oh, absolutely. You still need to evaluate the company's leadership, their competitive position, the overall market opportunity.
Of course.
All of that stuff matters.
Okay, so we've talked about looking back for value, looking ahead for growth. What about momentum investing?
Okay, so momentum investing is kind of like riding the wave.
Okay.
The idea is that stocks that have been doing well recently are probably going to keep doing well, and stocks that have been doing poorly are probably going to keep doing poorly.
So you're basically trying to jump on the train while it's moving.
Exactly. You're trying to catch that upward trend and ride it as long as you can.
And maybe even bet against the ones that are going down.
Right. Some momentum investors will short sell stocks that they think are headed south.
Okay, so this sounds like it requires a lot more active management.
It does. It's definitely a more hands-on approach.
And probably a bit more technical too, right?
Yeah. Momentum investing relies heavily on something called technical analysis.
Okay, and what is that?
So basically, it's about looking at charts of stock prices and trading volume.
Okay.
And trying to identify patterns and trends.
So like almost like reading the market's mind through the numbers.
Yeah, exactly. It's less about the company's underlying business and more about what the market is saying.
Okay.
It's kind of like reading the tea leaves.
Gotcha. And is it usually like a short-term strategy?
It tends to be. Yeah, momentum investors are often looking to profit from those short-term price swings. But the article does point out that you can actually get involved in momentum investing without having to do all that active trading yourself.
Really?
Yeah, there are momentum-style ETFs.
Oh, interesting.
So you can kind of get exposure to that strategy without having to be glued to your screen all day.
Okay. And then finally we come to dollar cost averaging.
All right, so this one's a little different.
Okay, how so?
It's less about picking specific investments and more about a consistent method for investing.
Gotcha. So what's the method?
So with dollar cost averaging, or DCA, you basically invest a fixed amount of money at regular intervals.
Okay.
Like say $100 every month, regardless of what the market's doing.
So you just kind of ignore the ups and downs.
Exactly. You're not trying to time the market. You're just consistently putting money in.
Okay. And what's the advantage of that?
Well, the main benefit is that it takes the pressure off of trying to figure out the perfect time to buy.
Right. Because that's involved.
It is. Even the pros struggle with that.
Yeah.
So with DCA, when prices are low, your fixed investment buys you more shares.
Yeah.
When prices are high, you get fewer shares. But over time, this can actually lower your average cost per share compared to like investing a big lump sum all at once.
I see. So you're kind of smoothing out the bumps in the road.
Exactly. And the article really emphasizes that this is like a disciplined approach.
Yeah.
It can help you avoid making emotional decisions, and it can even be automated, so you don't even have to think about it.
So it's kind of like setting it and forgetting it?
Exactly. And it's important to note that DCA can be used with any of the other strategies we've talked about.
Really?
Yeah, it's more about how you invest rather than what you invest in.
Okay.
It's about taking the emotion out of it and just being consistent.
Interesting. All right, so to recap, we've covered 5 different investment strategies.
Right.
Passive index investing, which is all about diversification and low cost
Mm-hmm.
value investing, where you're looking for those hidden gems that the market has undervalued.
Yeah.
Growth investing, where you're betting on the future stars.
Right.
Momentum investing, where you're trying to ride the waves of short-term trends.
Uh-huh.
And then dollar cost averaging, which is about consistency and discipline.
And the key takeaway here is that choosing a strategy and sticking with it
Right.
is way more important than trying to chase the latest hot stock tip.
Yeah.
It's about finding an approach that aligns with your goals, your risk tolerance, and your lifestyle.
And your time commitment, right?
Absolutely. Some of these strategies are much more time intensive than others.
Yeah, so as you're thinking about all these different approaches, I want you to consider this.
Okay.
What's the one thing that's going to have the biggest impact on your investing journey? Is it going to be your comfort level with risk?
Okay.
Is it going to be the specific financial goals you're trying to achieve?
Right.
Or is it going to be the amount of time and energy you're realistically willing to put into managing your investments?
That's a great question.
It is something to think about. And that's it for this deep dive. Thanks for tuning in.
Thanks, everyone.